cover on accounts receivable is we've been looking at a lot of different transactions that involve accounts receivable. And my question is, how do they impact liquidity ratios, specifically the working capital ratio, which is current assets minus current liabilities, gives you the amount of what's left over to work with. The current ratio, which is current assets over current liabilities, and the quick or acid test ratio, which is the current assets minus its inventory and prepaids. Or another way to say it, it's cash, marketable securities, and accounts receivable, which are our quick assets. In other words, we can quickly get cash from them over our current liabilities. So let's first look at the entries and then look at how those entries impact working capital, current ratio, and quick ratio. Do they make them go up or down? So sales on account, we know that that's debit accounts receivable, credit sales. Accounts receivable is a current asset. Sales is a revenue account. So if current assets are being increased by debiting them, working capital is going to increase, current ratio is going to increase, and the quick ratio is going to increase. Cash collection is debit cash, credit accounts receivable. Cash is a current asset, it's going up. Accounts receivable is a current asset, it's going down by the same exact amount. So there is no impact on either the working capital, current ratio, or the quick ratio. When accounts receivable are written off, we know that we debit the contra current asset account allowance and we credit accounts receivable. Again, here we have a current asset going up and a current asset going down by the same amount. So when we write off an account receivable, it has no impact on our liquidity ratios. An account receivable recovery, remember, takes two entries. One, you have to put it back on the books by debiting accounts receivable, crediting allowance. So there, a current asset is going up. Another current asset is going down. And the second, take the customer's money. So that's debit cash, which is a current asset, going up. Credit accounts receivable, which is a current asset, going down. So again, we're just switching one current asset for another, and it has no impact on our liquidity ratios. But bad debt adjusting journal entry does. So the adjusting entry is always debit bad debt expense and credit the allowance for doubtful accounts, uncollectible accounts, or bad debts. And a bad debt expense is an expense. Expenses are going up, so net income is going to go down. When we close net income to retained earnings, the shareholders' equity account, it will make retained earnings and shareholders' equity go down. The allowance account is a current asset account. Current assets are going down. So when I look at working capital, it only has current assets in it. Current assets go down, working capital goes down. Current ratio, numerator is current assets. It's decreasing, so the current ratio will decrease. And quick ratio, the current assets are in the numerator, the quick assets in the numerator of the allowance is decreasing, so the quick ratio will decrease. So hopefully this is a good review of all those things we've covered with accounts receivable and how they would impact financial analysis. Thanks so much for listening. I really appreciate it. On to the next module.